Welcome to Financial Strategies with Andrew and Daniel Agemy, powered by the Retirement Income Store and brought to you by Agemy Financial Strategies in Guilford, Connecticut and Denver, Colorado.
What was your first experience with savings bonds? Well, in mine, 1965, my elder brother, 12 years older than myself, gave me my first savings bond. It was a $50 bond that he paid $25 for, with the idea that at maturity, it would be worth $50. So about 15 years later, I was able to cash that in and got over $50 and ended up buying a Bible with it, which I have to this day. But nevertheless, that was my first experience with the savings bonds. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Today, we're talking about what are I-Series savings bonds. And Dad, that's a pretty interesting story. $50 back then did a whole lot more than today, huh?
Yeah, well, think about it for a minute, right? I mean, gas was probably somewhere in the vicinity of 25 cents a gallon or 30 cents a gallon if you're buying premium or something, right? So it could have bought a whole lot of gasoline, at that point, right? And today that doesn't even put anything in the truck. But nevertheless, we're talking about today, I-bonds and how the government's bonds work. And, there's a lot of talk, Daniel, about I-bonds, a lot of scuttlebutt between people, right? Everybody's saying, oh, you should buy these I-bonds because they're paying 9% interest and whatnot. And so, I think it's great if we take today and we talk about I-bonds, talk about these things and how they work. I-bond is a type of savings bonds, not the double E bonds that are usually used, but, I think it'd be great to go through that so that people have an understanding, because there's a lot of information out there and people don't know what people don't know. So let's help educate them.
Yeah. So there's two types of inflation protected bonds, right? That the government offers. One is TIPS, and probably more people have heard of TIPS, Treasury protected inflation bonds. And a lot of people buy these in brokerage accounts and things like this, typically through an ETF structure. There's another type of inflation protected that's more for the consumer that we've been hearing a lot of questions about because it's paying 9.6% right now. Now, this is as guaranteed as you can get in this world, right? It's from the U.S. government in their own currency. So they can't default because they can print dollars to pay you back, right?
Right.
But 9.6%, and it's a 30-year bond. And the way it works is the interest. We talk about bonds a lot. So this is right up our alley, right? We don't typically buy 30-year bonds for people, but this is a 30-year bond that investors can buy to try to protect themselves from inflation. So it's made up of an interest payment that's fixed for the 30 years. So that's 0.01% right now. And this adjusts every 6 months. So the next adjustment will be October 1st. Or I'm sorry, it'll be November 1st. Okay. So it will happen in November. And if you went and bought these I-bonds right now, you would get your fixed amount for 30 years at 0.01%. And then the inflation print from CPI would tack on the rest. So right now, from today until November 1st, when they readjust it, you will get paid an annualized rate of return of 9.6%.
Okay, so basically, if we call it 1 month left until November 1st, we're getting 1/12 actually in regard to that. So a little bit less than 1% for that time frame. Where annualized, if we annualize it out, it comes out to 9.6. So, but that's a 30-year bond, you said. So just to recap, we got TIPS, which is Treasury inflation protection bonds, and then we have I bonds, Series I savings bonds, I bonds. We have the iPhone, we have I bonds, we have I everything, right? So we got to have I bonds, right? So that's what it is. But there's caveats to this 9.6%, Daniel, right? And that's what we're wanting to bring across to the people in our listening audience today. What are the caveats? Because you hear about, these I bonds are paying 9%, but what's the rest of the story, Charlie, is the idea. And so that's what we're wanting to talk to you today. And you're listening to Financial Strategies with Andrew and Daniel Agemy. And as we go into telling you about, what is Series I savings bonds, we want to give you a paper that's called Bonds versus Bond Funds, Bonds versus Bond Mutual Funds. And this paper is something that can educate you on how bonds work. A lot of people, the word bonds gets thrown around all over the place. And sometimes when people talk about bonds, they talk about individual bonds. Sometimes they mean bond mutual funds. Today we're talking about I bonds, which we're talking about a type of individual bonds that works. Savings bonds work differently than corporate bonds, for instance. But that's what we're dealing with. And we want to educate you so that you'll be able to make smart decisions when it comes to investing your money. And you can have that bonds versus bond funds by calling us toll free 800-725-7616. Ask for your free copy of Bonds versus Bond Funds. You're listening to Financial Strategies with Andrew and Daniel Agemy. Today, today's topic is what is Series I savings bonds? So this 30-year bond paying 9.6%, but 9.6% is 9.6% for basically 6 months, and then it can change after 6 months, if I'm understanding right.
Right. Each 6 months it adjusts based upon CPI. So, I mean, 9.6 guaranteed, that's pretty good rate of return. Now, what is the catch, as they say, right? Like if you're driving down the highway and you see a billboard for a company that will get, a bank that will give you 4% on a checking account, you're not going to go cash out all of your IRAs and move your business checking and your personal checking and everything to that bank because it's a teaser rate, right?
Right.
So this is a real rate for 6 months. Most likely in November, inflation's still going to be high. It might be a little bit lower, but it's probably still going to be high. So maybe it goes down to 8%, or maybe it stays in the nines.
Or maybe it goes to 10 or 11 too. Who knows, right? It could.
Exactly. So when we typically talk about bonds, we typically talking about corporate bonds, right?
Yeah.
Which have a fixed rate of return. So you know what you're going to get. And then duration. We usually are talking about a lot less duration, right? So maybe it's 1 year, 2 year, out to 9 years compared to a 30-year. Now, one thing people don't realize with bonds is you can sell them whenever you want.
Okay.
You just because it's a 30-year Treasury bond doesn't mean you have to hold it for 30 years. Your guarantees are based on 30 years. So your interest rate on the fixed portion of the bond is guaranteed for 30 years. Now that's only 0.01 or something like that. So that doesn't really matter. You're buying this, you're interested in this for the inflation protection part of it, which is the bigger interest rate, right?
Yeah.
But you can sell it whenever you want. So you don't have to hold it for 30 years. That's just the guarantee. Same on a corporate bond. If you were going to buy that, you get your fixed rate, say it's 5.5%. Yeah, you can sell it. You don't have to wait for 9 years for it to mature. You can sell it anytime in between there. Both of these work that same way. Now, one has a fixed rate and one has an inflation adjusted rate, right? And so if you've got a bunch of money sitting in the bank, this may be a very interesting thing to you because you can put your money in here and assuming inflation stays the same in a year, with your $10,000, because that's one of those caveats you were talking about.
Right.
We'll get into that in a second. With $10,000, you'd make what? $960, right?
Right.
Not bad. Not bad in a year. And your principal is not at risk because it's from the U.S. government. Janet Yellen's going to go put this money right to work for you right away. She's going to do it herself.
You're basically loaning money to the U.S. government. That's going toward like paying off the, going toward the debt or whatever the case may be that we have. But you're loaning
paying
money
off
to
somebody's student loan, right?
Yeah, right. With the $10,000. That's exactly right. Good point, Daniel. Yeah. And, that's so here's what is going on, right? So there's what's called fixed rates, right? So like a savings bond will have a fixed rate. And I don't know what the double E bonds are paying right now, probably really low, probably the current ones are probably, I'm guessing, in the 3% range, I'm guessing. But that's a fixed rate, meaning that you're going to get that rate for whatever period of time. Like if you have money in the bank account or savings account, if it's paying something, or a CD, we've got CDs that are paying 3% for 1 year or less and higher for longer. But that's a fixed rate. The good news is you're getting 3%. The bad news is you're only getting 3% in a fixed rate, right? Whereas then we have this inflation protection stuff that if inflation goes up, you're getting a higher rate. So inflation is high right now, so that's why we're paying the 9.6. Inflation goes down to what it had been in the 2% range. Well, now maybe you're only getting 2% a year instead of 9.6%. So you got fluctuation there. The risk, it's an interest rate risk depending upon what inflation is. Then there's other things out there that go up when the stock market goes up, but down when the stock market, but not down when the stock market goes down. So they're getting interest based upon what the stock market did over that period of time. So from point A to point B, the stock market does X, Y, Z, and then the account holder gets A, B, C, a piece of what the stock market has done. So you got all these different kinds of ways of figuring out interest and how you can make money on your money without putting your principal at risk. So time's going by so fast already, Daniel. Here we are done with the first segment here. We need to take a break. And before we go to break, I want to let you know that you're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is, what is I-Series savings bonds, or what are I bonds? We have a book that we'd like to give you to help educate you, because people don't know what people don't know. And we want you to be an educated retiree, because educated retirees are stress-free retirees. We have a book that we like to give you called Return on Principal by my friend David Scranton, business partner David Scranton, that has what we're talking about is protecting principal. So this is Return on Principal. This will give you education. It's an easy read book that we'd love to put in your hand for free, calling us at 800-725-7616 for your free copy. Return on Principal. Ask for it by name. 800-725-7616. We'll be right back after this.
History tells us the market goes up and the market goes down. What would you do if you lost half of your retirement savings? It's time to make the shift to steady, reliable retirement income. And where do you go? The Retirement Income Store. Log on to agemy.com for your free retirement review. That's AGEMY.com. The Retirement Income Store, where retirees go for income.
Welcome back to Financial Strategies with Andrew Agemy in Connecticut and Daniel Agemy in Colorado.
So how many times does this happen to you? If somebody says, yeah, I'll get back to you on that, or I'll get you this information, or I'll do this for you, I'll do that for you, but it never happens. Reminds me, Daniel, of one A-Team episode from back in the 80s, 90s, whenever it was out originally with George Papard and such, right? Where Face came out and he said, "Hey, Murdoch, what do you say?" And Murdoch says, "I say a lot of things I don't mean." And I think that's really interesting, because a lot of things are said today that people don't mean, or they don't know what they're talking about. So that's why today on Financial Strategies with Andrew and Daniel Agemy, we want to be able to set the record straight on I-bonds and how I-bonds work. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Yeah, that's a good point, AAA. We this whole show is about trying to educate people, right? A lot of things, not that we're perfect, but we work really hard to give accurate information. And it's difficult when you're supposed to just come up with a lot of information, right?
Right.
People make mistakes. The press secretary the other day was talking about how good this administration is doing for the economy. And she told the reporters that they have created 10,000 million jobs.
10,000 million.
So that's about, what is that? 10 billion, 10 billion jobs. And there's 7.5 billion people in the world. So that's that's a great administration. That's pretty good. Pretty
In the
good.
world, 7 billion in the
Yeah.
world. They got more jobs than in the world. Great.
So that's pretty nice. That's
Yeah.
actually a pretty awesome administration right there. So, we try to break this stuff down, make it easy for people to understand, and we try really hard to give accurate information. And so we've
Right.
gotten a lot of questions about these I bonds. So we want to explain how they work. I want to
Yeah.
explain some of the myths on other types of investments as well. We did a pretty, I thought, interesting show last week on what real life insurance is, not death
Right.
insurance, life insurance. So people
Right.
can go check that out on our website if they'd like. But there's misconceptions on a lot of things. So
Yes.
another one that we're talking about today is bonds, individual bonds, right? That's what
Right.
we're talking about with this I bond. You own it.
Right.
So you get to decide if you want to hold it. If the inflation rate comes down from the 9.6 it is, you get to decide if you want to sell it and go into something else, or if you want to hold it. There's not a fund manager that decides because somebody else wants to get out of it that you have to get out of it. You own it, and you own the individual bond, and you get to sell it when you want. You get to collect the interest. You get to decide if you want to take the interest or leave
Yeah.
it in the account, right?
Right. Right. Right.
So going back to these I bonds, there's the fixed rate we talked about, and then there's the adjustable rate. So right now it's 9.6%, and adjustable, right? That will adjust in November, and then you will collect whatever that new rate is for another 6 months.
Yeah.
On these things, the minimum or the maximum you can put into them per Social Security number is $10,000
Okay.
a year. Now, there is a way you can use your tax refund to get a little extra in there, but it would be a paper bond. So we're not going to go into that. We're just talking about, like, if you've got money sitting in your checking, you want to do this. So if you have a family of 4, right, you
Right.
can do $10,000 for you, $10,000 for your spouse, $10,000 for one child, $10,000 for another child. Now you got $40,000 into these accounts. You have a business, you could put another. So you got 50,000, or you have a trust with the tax identification number. Now you have to be a U.S. citizen. You have to have a U.S. Social Security number. But that's a way you could get $50,000 in. There's another interesting thing that you could do with these, where there's a gift option when you're buying them. Okay. And so you could designate $10,000 to someone who already has. So you're going to give $10,000 to your child.
Right.
So they look at it and they say, well, this Social Security Social Security number already has $10,000. So it will push the gift out till 2023, call it, or 2024. All right.
Wow.
But it starts accruing interest today. So that's a way you
Wow.
could get $10,000 in for that child. So if you did that for all of your family,
Yeah.
and let's say you have a trust or a business, you could get $100,000 in
Mm-hmm.
in 2022.
Right.
Now that's a lot of work, but for
Yeah.
some people, they got just a lot of money sitting around. That's an interesting concept.
Very much so. Very much so. And my understanding of how that works, Daniel, is like you open up the account for 2022, and then you have this opportunity to set it up for a gift, so that you're set up, 10,000 as a gift for each entity, each person for 2023. Then once 2023, it starts collecting interest now because you did that. But then in 2023, it would actually basically hit the account, is my understanding. Am I on the right track with that?
Yeah. exactly. It could roll over into their account, but it's a way to get extra money in. I mean,
Yeah.
another way you could look
Right.
at it is you could say it's going to be gifted to them in 2024, and then in 2023, which is 4 months away, you could buy
Right.
another 10,000 for each of you. So now you would have, in that scenario, you'd have 10,000 for each from 2022,
Right.
10,000 for each for this gift you're going to do at some time,
Right.
and then 10,000 for each for 2023. Now,
Hmm.
within 4 months,
Yeah.
you've got $150,000 into these things.
Well,
So
for that 5 people. Yeah.
for 5 people.
Yeah.
So one of the negatives we hear about these things is you can't get a lot of money in. And
Mhm.
that's true. It's difficult to get a lot of money in. But for someone who wants to do the work and wants to do these things and then watch them and see what the rates go to and everything, this is a way that you can get a lot of money in.
Yeah. Yeah. You're listening to Financial Strategies with Andrew and Daniel Agemy, and today's topic is what is Series I savings bonds? And because people don't know what people don't know, so we hope we're educating you on how I bonds work and bonds in general. And to go along with that, we have a paper that we'd love to put in your hands: bonds versus bond funds. A lot of people understand that bonds are safe compared to stocks, generally speaking. But so many times people, when they're talking about bonds, they're talking about bond mutual funds, which bond mutual funds are not safe like individual bonds are. And that's what we've been talking today about with I bonds are protecting principal, but mutual funds really don't protect principal. So we'd like to give you this paper that you can read about it and educate yourself on it so that you can make smart decisions, especially if you're do-it-yourselfer. And you can have that for free by calling 800-725-7616, 800-725-7616, bonds versus bond funds. Daniel, a 30-year bond that you could, after the first year, you could cash it in, you could sell it, you could get your money. But some people are not going to cash it in after the first year. Some people are going to forget about it, and it's going to go on into the future. And then inflation, if it, on average, right, has done what, 3% on average over what, the past 30 years or something roughly. And so that 9.6 can very easily come down. So the average over the 30-year period is not going to be probably 9.6%. And if it is, we're all in a heap of trouble.
Yeah. Yeah. Yeah, you're exactly right. So you have to hold this for a minimum of 1 year, right? So you can't sell it in 12 months. So you have to
Right.
hold it for 12 months. And then if you sell it within a 5-year window, the penalty for doing so would be 3 months of interest. Okay, so
Uh-huh.
so you have to hold it for 12 years. So this can't be emergency funds, right? You're
Right,
not
right.
you got $10,000 in the bank and you say, I'm gonna go buy this so I can earn 9%. No, this isn't emergency fund money, unless you have like an emergency fund account,
Right,
right?
right.
Because it's not liquid, it's not accessible for the first 12 months, and then after that, the penalty would be, unless you hold it for 5 years, you've got to give up 3 months worth of interest. Now, if it stays at around 9%, giving up 3 months interest is not really a big deal.
Right.
Um, and Another thing that people need to know with these things is how the interest accrues, right? So typically when we're
Yes.
talking about fixed income, we're talking about it pays you, right? And then you get to decide what to do with it. So if we were talking about $100,000 bond paying 5.5%, you could get $5,500 a year. And then you could say, I want to reinvest this at whatever current rates are, or I
Right.
want to buy the stock over here, or I just want to go on vacation, right?
Right. Right.
With these, the interest accrues monthly, but it reinvested into more I bonds semi-annually.
Okay.
And the taxation's kind of cool. although it reminds me a lot of like a whole life insurance policy or a annuity, because it's not taxed on a state or local level.
Okay.
And then you can
Tax-free.
defer the taxes on a federal level. So if you made, 90 or $960, right?
Mhm.
Which say it stayed the same. You made that, that would buy you $960 worth of I bonds. And then you could pay the tax on that if you wanted to. You got to communicate with your financial professional, your tax professional, or you could defer that up to 30 years when the bonds come due.
All right. So you make invest $10,000. You make $960 this year. You have it for 1 year. You cash it in. You sell it. You're going to pay tax on $960. But if you keep it for the 30 years or for however long, you're not going to be paying tax on that until you actually cash it in. So if it continues to build and you actually double your money and your $10,000 turns into $20,000 and you cash it in, well, now you're paying tax on half of that because half of that is growth. So it's kind of like a tax deferred annuity from that standpoint, is you're paying taxes on the growth once you take it out, federal taxes, but you're not paying state or local taxes on this money. So it's partially tax-free, but federally it's taxable when you take it out. All right. Good stuff to know, knowing all the ins and outs of this stuff. We have more to come. In the meantime, we need to take a break, and we want to, you're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is, what is Series I savings bonds? And we have a book that we'd like to give you. Series I savings bonds are designed to protect and preserve principal. We have a book called Return on Principal, which will be able to help you to understand how to be able to do that a little bit differently than just stock market investing. We love to be able to give this to you so that you can read and educate yourself on it. It's by David Scranton with all kinds of alphabet soup after his name. And we'd love to put this in your hand. Call us at 800-725-7616, and you can have it for free. Just ask for it. Return on Principal, 800-725-7616. We'll be right back after this.
I'm David Scranton, founder of the Retirement Income Store. If you're in or near retirement, are you certain you have the right retirement plan in place? Do you want to help ensure your nest egg will last you all throughout retirement? Take our retirement review quiz and find out in 5 minutes or less if you're doing everything you can to achieve a more successful retirement.
Visit us online at agemy.com. That's AGEMY.com. Welcome back to Financial Strategies with Andrew Agemy in Connecticut and Daniel Agemy in Colorado.
So Bill and Ted come into the office and they say, have you guys seen these I bonds? These things are incredible. You can get 9.6%. I want to cash out my IRA. You have to buy them from Treasury Direct. If I cash out my $200,000 IRA, I'll end up with $150,000 right after I pay taxes, and then I'm going to put a little bit into each of these accounts so I can get all $150,000 into the accounts in the next 6 months. And we say, well, that's a great idea. Who doesn't want to make 9.6% on their $150,000 that used to be $200,000? I'm Daniel Agemy.
And I'm Andrew Agemy. You're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is, what is I-Series savings bonds or I bonds? And because we want you to know what people don't know. So Daniel, that's an interesting story. That who, like you say, who doesn't want to get 9.6%, right? But the crazy thing is, in that example, they're giving up $50,000, which is 25%. And actually probably be more than that, because it would push them into another tax bracket, and then there's state tax and other things besides that. But let's just keep it simple with 25%. But that seems to me like that would take a while to actually recoup what you're paying in taxes in order to do that.
Yeah. So this is where it gets a little bit tricky on these things, right? Um, it you're not guaranteed 9.6% for an extended period of time. It's just for 1 month right now, and then the next 6 months will probably be close to right,
Right.
close to
Right.
that. So let's say that over the next 5 years, it averaged 8% per year, which I think is a high number because I tend to think the Federal Reserve is out there telling you that they're going to bring down inflation.
Right.
I tend to believe them. They're going to bring down inflation, right? If that means that they bring your house down, your house
Right.
down
The value of your house. Yeah.
by 25% or your stock portfolio down by 40%, they
That
will do
will
that, and
that
people
will
will
curb
stop spending
inflation.
money. So I
Right.
think they're going to stop this inflation. Like you said, we're going to be in a pretty bad spot if we have
Right.
inflation at 9% for the next 5 years. But let's say
Right.
it did 8. You'd be back to even over 5 years. 8%, you'd get your money back
Okay.
over 5
Your
years.
taxes that you pay, you get that back over 5 years. So at 5 years, you're
You
just
paid
at
nothing.
even.
Yeah.
And that's at 8%
Yeah.
over 5 years.
Right. So if you've got qualified money and you really want to pay taxes, maybe you should think about converting to a Roth IRA,
Right.
pay the taxes, and then let that grow, because
Right.
then you'll never pay taxes on that money again. Whereas in this scenario, there's no certainty what you're going to get after the 6 months.
Yeah.
And you'll still have to pay the taxes when the money comes out.
Right.
So now 5 years later at 8%, you got back to even, right? And
Sounds like a
and
bad deal to
taxes
me.
due, right? So
Yeah. Does-
So Bill and Ted, we had to damper their enthusiasm, but Bill and Ted were still able to participate with money in the bank, right?
Right. Right.
But
And that's the point.
each thing, each idea, each concept we try to explain and talk about, they're all strategies that work in different scenarios for different people.
Right.
Risk tolerance plays into it. The money you have available plays into it. The type of money, right? Is it
Right.
qualified? Is it non-qualified? Your
Right.
time horizon. All these kinds of things play into it. The other thing Bill and Ted didn't understand was that they had to do it themselves.
Right.
So you have to go to Treasury Direct and you have to transfer the money from your bank account into Treasury Direct. Then you have to watch it. And Bill and Ted like stuff simple, right?
That's not simple.
They didn't want to have 5 accounts and then 3 accounts that are associated with those 5 accounts that they have to watch because if rates come down. So these things work really well if you like having your hands on, right?
Right,
Paying attention to stuff, checking stuff every day, generating Excel spreadsheets each month of how much accrued interest you have, right? These are good for those types of people and people who have a lot of money in the bank.
Right. Right. But so, it sounds like in those scenarios that you're putting forth there, especially with Bill and Ted and whatnot, that people can really end up this could end up being detrimental to them, all meant to be good, all with the best of intentions, but not knowing what they don't know, and what you don't know could hurt you. Right. So if you're listening today, and as we go through and talk about on financial strategies, what is a I series savings bond or I bonds? Ideally, you're going to be getting information today so that you can make smart decisions and not make mistakes. Daniel mentioned treasurydirect.gov if you're interested in the I bonds that you can go to and do it yourself from that standpoint, some limitations associated with that. But as we talk about this, we're talking about a form of fixed income investing where you get a fixed rate. This 9.6 he's talking about is for basically 6 months, or actually now until November, until it changes in November. And then it will change for the next 6 months. But we have a paper that we'd like to give you that would help educate you in regard to this stuff called The Case for Fixed Income, and how to avoid mistakes along the way that many people make. Most people don't understand fixed income because they're so enamored with the stock market or so enamored with the bank. Fixed income is a different thing for them. So we'd love to have you read this. You can have it for free by calling 800-725 7616, 800-725-7616. And just ask for the paper, Fixed Income. All right. And we'll be glad to get that off to you. You listen to Financial Strategies with Andrew and Daniel Agemy because people don't know what people don't know. Daniel, what else is about these I bonds that people don't know? I mean, you're telling this is all good stuff that you're saying because people don't think about, if I pay the taxes, it's going to take me 5 years at 8%, but it's probably not going to be 8% for 5 years. People don't think, it's a 30-year bond. So, chances are what we've seen experience of people do is that, human nature is such where they're going to leave it for the 30 years. And then it's going to end up with maybe a much lower average, where if they put it in other things where they could get, give or take 5% on average every year, they may be much better off. But people don't see things in these light, right?
Right. So this adjustable rate is based upon consumer price index. So when we think of inflation, we think about like housing, right?
Right.
The housing has gone up tremendously in the last 10 years, right? You
Right.
think about healthcare. Healthcare has gone up tremendously in the past 20 years.
Right.
Automobiles, right? You want to buy a new car. These things have gone up tremendously. But consumer price index is like a couple percent a year, right? It's averaged a couple percent a year. So if it drops back down to the average around 2%, then you're going to get that 0.1, 0.01, and then you're going to get, the 2% or whatever it is. So calculate that in. The good thing is, for example, in May of 2009, we had a negative 2.7% interest rate. So the question would be, well, does that mean I'm going to get a negative return on my I bond if inflation goes negative, right? And the government won't charge you negative, so it'll just be zero that year. They're not going to penalize you for having negative inflation prints. So
But that's going to bring down your average return. So your 9.6 comes down on average because if you get a zero return.
Right. That's why average, that's why historical numbers are so important when we're looking at things. They tend to trick us, right? We look at either the current numbers, or we look at an average and we forget either the pain in the meantime, right?
Yeah.
If the stock market averages 8%, 10% a year over 150 years, I think it's 9.5 over 150 years. Well, that sounds really nice. But what about when it was down 40%?
Right.
Could you put up with that? Because that's not an average. That's a real thing that you're experiencing and you're going through and you have to suffer through, right? So same with this. Right now, it's a great number. But when you look at next year or the next year, do you want more consistency? And that's where if you're talking about like a CD that's paying 4% for 5 years, you're going to get 4%. You may be happy with that. You may be somebody who just wants to know, hey, I want to make 9.6 because that's the most possible and a guaranteed rate.
Right.
And that I'm going to move it to something else, in a year from now. So that's why you just have to understand these. But the 4%, the tortoise and the hare, right? The tortoise might be getting that 5% CD or that 4% CD for 5 years. And they're happy with that because they know no matter what happens with consumer price index, they're going to make 4%. So $100,000, right? They're going to make $4,000 each year for 5 years. They're happy with that. Somebody else, the hare, right, says, I want to get that, but I don't know what's the volatility. I don't know what the uncertainty is going to be. So that's kind of who each of these types of things are for. And then the really aggressive person who wants to just a home run is saying, well, I'm looking at stocks and these things are looking pretty cheap right now. So it really depends on the type of person that you are.
A lot of variables. And that's why strategies are important to understand what kind of strategy you want to have. in regard to this. And, and in that example, that 4% for 5 years, Daniel, it doesn't sound very exciting, but with compounding and stuff, such, it could turn out to be about 22% over that 5 year period of time. Which is not a bad rate of return compared to a 9.6 1 year and 2% for a couple other years, and ends up to be 18% over that 5 year period of time instead of 22. So a lot of things to take into consideration. And that's why, we want you in our listening audience to know what you don't know, because we're trying to give you all the facts that you're not going to hear from other places. You're certainly not going to hear the stuff from Wall Street, because Wall Street doesn't make any money off of this stuff, and they're not going to want you to know anything about this. We just want to educate you, because we know that if we educate you to make smart decisions, that you're going to be we're going to add value to your lives, and that's what we're all about at Agemy Financial Strategies, is adding value. And you're listening to Financial Strategies with Daniel and Andrew Agemy. Today's topic is, what is Series I savings bonds? And we're going to take another break. Before we do, we'd like to give you this book, Return on Principle, by our friend David Scranton, which is going to help you, easy read book that's going to help you be able to educate yourself on some things that you're not going to hear from the talking heads on TV and Wall Street and regular news media. But it's yours for free by calling 800-725-7616. 800-725-7616, or check us out on the web at our website, agemy.com. The two words, age, my spell our last name, but Agemy, and check us out there and contact us there if you prefer that. We're going to need two forms of identifying you and contacting you in case one doesn't work. So 800-725-7616. Call now.
History tells us the market goes up and the market goes down. What would you do if you lost half of your retirement savings? It's time to make the shift to steady, reliable retirement income. And where do you go? The Retirement Income Store. Log on to agemy.com for your free retirement review. That's AGEMY.com. The Retirement Income Store, where retirees go for income.
Welcome back to Financial Strategies with Andrew Agemy in Connecticut and Daniel Agemy in Colorado.
So it was February 1st of 1935. Franklin Delano Roosevelt signed legislation allowing the U.S. Department of Treasury to sell new type of security called U.S. savings bonds. And savings bonds, there's been some kind of non-marketable treasuries that had been issued ever since 1776, but they had fluctuation associated with the markets, and there were people, especially lower savers, that lost money with those. And so they came out with these in 1935 in order to keep people from actually losing principal, have some principal protection from that standpoint. And the savings bonds were offered. So with a maturity date and that kind of thing, and there's A bonds, B bonds, C bonds, D bonds, so forth. Now we got double E. Now we're talking about I bonds. I bonds came out in 2002 as an electronic version of bonds, because previously bonds were a paper document kind of thing. And 2002, they started treasurydirect.gov, which is where you would go to buy these things. And that's when they came out with the I bonds. And now, so I bonds are not something brand new. They're 20 years old, but we're hearing about them now because inflation is really going crazy, which it hadn't until now since I bonds were issued. So I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Today we're talking about what are I bonds, and that's pretty interesting. That's a kind of neat thing that the government did for investors. They've always issued bonds for different things. They used to call them like war bonds, and when people were more aligned with their government, more trusting, maybe I should say, of their government, they wanted to help. Now I think a lot of people trust the military. Well, there's studies that show the military is the only governmental agency that's trusted by the majority of U.S. citizens.
Wow.
politicians are not, right? The FBI
Right.
is not. All these other kinds
Right.
of things are.
Good point.
It's the military, and that's what studies have shown. But they've always issued bonds to fund stuff, and there are still people that would probably give money to call it a war bond, but they're not going to call them war bonds. That they would call it like Save the Kitty bonds or something, or I bonds like iPhones, right? No, but it's a way that the government is able to fund different things, as you said
Right.
at the beginning. But the neat part is you don't have to deal with duration risk with these things.
Right.
And typically, when people think of a bond, they think, well, I don't want fluctuation.
Right.
Now, what a lot of big investors, why do big investors or hedge funds like the long bond, right? 20 years, 30-year bonds so much? Do they like the 4% it's paying right now? No, they're interested in the capital appreciation, right? So it works both ways.
Yeah.
If you have the 30-year bond and rates come down
Yeah.
1%, you could get, 20, 25% in
Nice.
appreciation on your account. So a lot of investors will use that to hedge their market risk.
Okay.
It could work the other way around, right? If you
Right.
own a bond, a 30-year bond, let's say, and
Right.
rates go up, the value of your bond could go down. Now,
Right.
you always have the maturity date when you own an individual bond, where it will be bought back from you for what you paid for it. But most people don't want to wait 30 years for that. That's why you go shorter duration. Well, what they did with these in your story is that they took the fluctuation out, right?
Right.
So
Right.
typically you buy a 9% bond,
Yeah.
9.6% bond, and it would be above par because everybody'd want to jump into it and it'd drive the price up. And
Right.
then when it adjusts and it comes down to 2%, the
Yeah.
historical average, then the value would go under par and you wouldn't be able to get what you paid for it anymore unless you waited to the 30 years for them to buy it back from you.
Right.
So what they did was they made it non-marketable. It's just you buy it and sell it to the Treasury. There's
Right.
not other investors bidding on your bonds, which is kind of neat to use it as a long-term savings account maybe, or a college education fund. You just got to be careful, like we said, because in 6 months, you don't know what it's going to go to.
Exactly. Exactly. And that's, as you're talking about that, my mind is going to how bonds, what bonds work. And with this, you mentioned war bonds and such, but war bonds are something different than savings bonds. They're similar but different, right? They were a different thing. And I find it kind of interesting because when I was researching this, Daniel, for those conscientious objectors or religious objectors to the war effort, right? They had a bond for them. It was called the National Service Board for Religious Objectors, is what it was. So, but
did it go to like the medical, like Red Cross, or did it go to like?
That's excellent because I'm reading on this and I don't see exactly what they used it for, but I'm sure it was probably something like that they weren't using it for the war, but per se, right? They weren't buying guns and tanks and everything with it, but they were doing some other things to help with that as well. So it's kind of interesting. But anyway, the point behind that is that these things can be used in different situations for different things, right? And this is what I want to say to you in our listening audience is that, if you have savings bonds that maybe were gifted to you or that you inherited or that maybe you bought yourself years ago, please go on treasurydirect.gov and you can punch in those serial numbers and it will tell you what if it's still gaining interest or not. All right, because some bonds are no longer gaining interest. And if you're got that money sitting in that money, not gaining interest, that's ludicrous, especially with, we can get you CDs at 3-4% right now. So 3-4%, it's not huge, but it's a whole lot better than nothing. And with inflation, that's like burying your money in the ground, or it's worse than burying your money in the ground from a certain standpoint by getting nothing on your money. So you want to be able to check that out. Anyway, you're listening to Financial Strategies with Daniel and Andrew Agemy. Today's topic is, what is Series I bonds? And we're bringing this to you because people don't know what people don't know. We want to educate you because an educated retiree is a happy and stress-free retiree. And we want you to be in that fashion. Whether you're in retirement or you're close, fast approaching retirement, we want you to understand how you don't have to make the mistakes that others have before you. We have a paper that we'd love to give you to go along with this to help you educate you on how not to make some of these mistakes. And it's called The Case for Fixed Income. So you can have it, just call it, ask for it by name, Fixed Income Paper, 800-725-7616, 800-725-7616, or check us on the web, agemy.com, agemy.com. Daniel, we're closing up here. We only have a few minutes left here. Again, we're going by really fast. And, what do we need to say? What do you need to say to our audience as we close up?
Well, we appreciate, all the listeners. We appreciate the people who gave us this topic to speak about. And if you are enjoying this, it's a little bit different than we typically do, or you have topics you want to hear about, then you can, let us know. If you're watching on YouTube, put it in the comments. If you're on the radio, call the office and just tell us what topics you'd like to hear about. And we will do our best to address those topics that you want to hear about. That's where this one came from. A lot of people were asking questions about I-bonds and how they work and if they're a good investment. And we hate saying it depends, but with most investments, it's really specific to individuals. And if someone's telling you, this is what you put all your money in, this, cash out your IRA, this is the one thing, you got to rethink, is this really the thing? Because each person's so different, and each person's needs are so different. And I'm not going to say never, but it'd be very seldom at best that there's one thing that fits all or that's right for everyone.
Right.
And so usually it's about the strategy, how you use those, and how they work with each other, right? Diversification is one of the absolute best things to have a durable, stress-free retirement. Is diversification, because true diversification means why something's coming down, something else is going up, right? You have non-correlated or negatively correlated assets that work together, right? And then when you can tack on the income on top of that, that's a wonderful thing, because it doesn't matter what's going on in markets. If you have the income you need to survive, right? If you have the income you need to maintain the lifestyle that you want to have. And that's why we're always talking about income. And right now is some really uncertain times. What the Fed's going to do, what inflation's going to do, what the stock market's going to do. It's scary because Jerome Powell's out there telling you there's going to be pain. His last speech, he's talking today, but I'm talking to the Jackson Hole one. An 8-minute speech, he said pain 2 times. There hasn't been another Federal Reserve chef in a long time that's mentioned that, right? He knows what he's doing. They know what they're doing to bring down inflation, and it can be painful. So you need to look at things that can preserve your wealth and generate the income that you need to maintain the lifestyle that you want to have, even if they do bring markets down big time, right?
Yeah.
Another 10, 15, 20% from where they already are down to stop inflation. So this is one thing, right? This Treasury Direct, these I-bonds, this is one way to protect your purchasing power, one way to protect your principal. We've gone over some other things, but please let us know, how are we doing? You like this kind of content? You want to hear about other things?
All right, exactly. And I just want to reiterate, the I-bonds are 30-year bonds, and they're the max you can put in per Social Security number or EIN number is $10,000 per year. So be aware of this. You're listening to Financial Strategies with Andrew and Daniel Agemy. Before we sign off, we want to give away this book, Return on Principle, written by a friend of ours and business partner, David Scranton. And we'd love to put this in your hands because he's got some good stuff in here that will be able to educate you, help you to know what you don't know, so that you can make smart decisions, because an educated retiree is a happy and stress-free retiree. Call for your free copy at 800-725-7616, 800-725-7616. You too can have a stress-free retirement.